Thank you for joining us today for another episode of the Dealmaker series. Today, I'm joined by a partner at Skytale Group, James Turcott. James, I have not had the opportunity to interview you yet, so I'm excited. Thank you for being here with us. Tell us about yourself. Tell us about the firm.
Yeah, thanks for having us. Excited to be here. My name's James Turcott, partner at Skytale. We are a management consulting and investment banking firm that plays in the lower middle market. The firm was really created on the basis of bringing sophistication to the lower middle market, whether that's founder owners or private equity that plays within those spaces. Within our consulting team, we focus heavily within the medical aesthetics and dental space, are kind of the two focuses there. We're a healthcare focused firm in totality, but those are kind of the two spaces we've played in. From an investment banking standpoint, we work with mostly founder owners in their transactions, and from a EBITDA standpoint, anywhere from a million EBITDA to 10 to 15 in EBITDA tends to be our sweet spot. In where we play, most of our clients are multi-site healthcare practices that we look to transition to either a private equity group or a strategic partner backed by private equity. Our last vertical is we have a private capital fund that we look to take small equity stakes in either our current clients or outsource deals that need a little bit of growth capital.
That's awesome. From a marketing perspective, I love to hear all of the niche categories there. You're pretty specific, so I love that. Let's jump right into it then. Let's talk about the deal flow. What is the current state of deal flow that you're seeing? Is it increasing, decreasing, stagnant? What do you got?
Yeah, so for us, I mean, we've definitely seen an uptick, I'd say, over the past 6 months or so. For healthcare on our end, really around the election time was when it started to become a little bit slower. People waiting to see what the administration looked like, regulatory risk, et cetera. In going into 25, we saw a bit of an uptick, starting to get deals signed up, and now, I'd say leading into Q1 next year is where a majority of our signings are ultimately going to work towards close. And so, I think we've seen quite a bit of activity pick up. We play in a very niche space to your point, and in a space that a lot of private equity has looked to get into. And so I'd say we're fortunate in that sense where, we do see quite a bit of activity within kind of the medical aesthetics world. And we've also seen a little bit of revival of dental. That's been pretty quiet over the past 2 to 3 years, and so for us, it's a welcome, kind of active environment right
Yeah, so we're coming out of Q3. We're kind of in the, I guess, in the middle of Q4 now. Have you noticed any particular changes or upticks in Q3, Q4?
now. No, I mean, for us, usually what we find is everyone's trying to get deals closed at this time of year versus, kind of signing on. So we're in the process of working towards close on a few deals. And then we started to hear, some outreach of people looking to go maybe early next year, finish out the year strong, and have really nice financials that we can kind of take, package up, and ultimately get out to market, in Q1 next year.
What about deal structures? Are you seeing any particular trends or nuances there?
Yeah, I mean, for us, healthcare is very provider dependent for the most part, right? And so we see typically in our structures, there's usually some sort of rollover equity component to it where, we call it 70% cash at close, 30% rollover equity. Obviously, those things are negotiated depending on, what the owner is looking for. But rarely do we see an all cash, type of deal on our end, especially kind of in healthcare where the providers are really the key to those businesses. And so, we buyers want to ensure that our clients stay aligned with, the growth that they're looking for in the platform.
That's interesting. You mentioned you don't typically see all cash. Something I've noticed this year from a lot of folks I've interviewed is that they're seeing more all cash deals. Now, those that do have that equity rollover, I've also heard that the percentage has moved up some. Or it used to be maybe 10 or 15%. Now we're looking at more like a 20 to 25. Are you seeing the same or what kind of idea
Yeah,
do you?
I think so. I think it creates even more alignment if you have, a seller that's willing to roll a bit more, right, and has more skin in the game from that side of things. So I'd say I don't know that it's necessarily like an uptick. I think buyers are always happy and start high, frankly, on wanting to get those sellers in at a higher rollover amount. I'd say it really comes down to alignment at the end of the day and the way we see it. And so, in order to get a deal done, maybe someone is willing to drop from 30 to 20. But ideally, the starting point is, to your point, we've seen it kind of go up, as far as where the starting point, I guess I'd say. We've seen.
So I know you focus on the healthcare side, and I'm curious. You mentioned, I think it was DSOs, MSOs, MedSpa, or where you focus. Are there any amongst those, or any others that you haven't maybe named? Are there any particular sectors or categories that are particularly active in this quarter or this year?
Yeah, I mean, I think so. Med spa is definitely one for us. What's interesting is like the offshoot of med spa. So it's such a young industry where we've seen a lot more of the wellness and kind of longevity add-ons to kind of the med spa world. So, think about hormone replacement therapy, men's health, concierge medicine, those types of things. And so I think, there's a lot of things that kind of med spa started, and there's a lot of momentum behind it in other areas of wellness and aesthetics that we've kind of seen either been tagged on to current practices or, standalone, platforms that are created around that wellness and longevity. So that's been an interesting space for us. And then the typical healthcare sectors that, you see out there. We've seen a few deals here and there, but with our niche, that's kind of where we try and dig in a bit.
Very interesting. Very interesting. What about elements that are impacting deals right now? I know everyone is interest rates and tariffs are top of mind for everyone. Are those impacting any of the deals that you're seeing, or are there any other elements impacting deals right now?
Yeah, I'd say, for us, interest rates definitely were something we had to kind of work through. The tariffs didn't affect the healthcare business we kind of worked with as much. It was more regulatory with the election and those types of things. So it wasn't as much tariff driven as I think some other industries out there. But from are we seeing things change a little bit? I'd say diligence is taking a little bit longer than what we typically had seen in the past. And so when a lot of times it was a 60 to 90-day sprint. We're seeing more like a 90 to 120-day sprint. And so, I think that's kind of been probably the biggest thing that we've seen along the way. And, internally trying to make adjustments for that and really, managing the client expectation too, right? Everybody wants a deal to get across the finish line. But I think we've seen buyers take a little slower, make sure every, T is crossed, I is dotted, especially if there's obviously a lender in play and all that good stuff.
Yeah, definitely. Along with the consensus I've gathered this year, is diligence is taking a good bit longer. What about let's kind of shift here a little bit toward our geography. Is there anything about DFW or maybe Texas that has made deals more interesting or unique, or maybe less interesting for any of your
Yeah.
investors?
So I go back to like regulatory in Texas, and I'm by far I'm not a lawyer. They know more than I do, I think. But the way we've seen Texas is tends to be a fairly I don't want to say friendly state, but there's a bit more of business friendly kind of things set up. And so the way we think about it is, we've seen deals get done in Texas. We actually did a deal down in Waco this past year, and we have another one that's kind of out to market in the Texas state as well, that's a bit sizable and has gotten quite a bit of traction. And so for us, we haven't seen Texas slow down deal flow. I'd say, I'd say we are nationwide and where we focus, and so I'd say we're excited about getting a Texas deal here and there, but it isn't something where we just have a sole focus in Texas.
Okay, fair enough. I like it. All right, last question. I'll ask you to take out the crystal ball here, and let's look into the future. What shifts do you see coming in the deal making space over the next several months or next year?
Yeah, I mean, I think for us, I think it's kind of status quo. I'd say. I think interest rates. I was talking to a friend yesterday, and they expect it to come down a bit more, and so that's obviously helpful. In kind of the deal making space. I'd say the other piece of it is the regulatory risk around the spaces that we play in, and so I think if there's increased regulatory kind of oversight, or there was a Texas legislation that came out around med spas at one point that was proposed that an MD had to be in the practice all day, every day, and that just cripples kind of a business, right? And so, thankfully, that one kind of got put to bed. But where I'm going with it is, I think a lot of our deal flow tends to be regulatory driven, especially with how young the aesthetic space is. And so, we keep an eye on state by state where people are moving. There's a couple states that have made it harder to get deals done that we've seen, and that's kind of trickled down to, as we get clients in those states, there's really a select buyers that are comfortable moving into that space. It hasn't allowed us to open up our full kind of buyer list that we typically have access to. And so I think those are the things that we continue to keep in mind over the next year or so as just the space matures and we continue to kind of dig into it further.
Okay. So, just kind of a follow up there. Have you seen any upticks around the use of AI in any of these businesses in any aspects?
Yeah, I mean, I think that's the hot topic, right? Like you can't go to a conference nowadays
Right.
without someone asking about AI. And
Yeah.
I think
Yeah.
the answer is yes. I mean, I think generally the way we think about it is everybody's going to try to use it, everybody is going to try to adopt it. And I think if you're able to do it well, you're going to excel at that point, right? And so what's interesting is the businesses we play in kind of are consumer healthcare business, right? And so AI continues to be a big component of how you attract patients, how you retain patients, how you confirm their appointments, etc. And so there's a lot of operational efficiencies that we've seen try and be put in place. I think it's you still get the pushback of where people like to talk to a real person and not a full AI thing, but we've definitely seen a focused push within the space of healthcare in general, and within the sectors we play in to either be more efficient at the front desk or kind of understand how you can identify where patients come from, all those good things that kind of make the business a bit better and more attractive ultimately in the market.
For sure. Good deal. Excellent insights, James. I appreciate your time and some of your inputs there. For those watching, hopefully you find this all useful. And to find more episodes from the Dealmaker series, check out my YouTube channel. James Turcott, Skytale Group. Thank you, sir. I appreciate you.
Thanks, James. Great talking to you.